In 2021, Elon Musk paid roughly $11 billion in taxes, the largest individual tax bill in American history, and yet his net worth grew by over $100 billion that same year. So where did the rest go? Because if you do the math, something doesn't add up. And when you figure it out, it changes the way you see wealth entirely. Here's what most people think billionaire wealth looks like. A founder builds a company, the company goes public, the founder cashes out, buys a yacht. Simple. But that's almost never how it actually works. The reality is that the vast majority of billionaire wealth isn't cash, it isn't gold, and it isn't sitting in some offshore bank account. It's stock. Jeff Bezos, primarily Amazon shares. Elon Musk, Tesla and SpaceX equity. Mark Zuckerberg, Meta. Larry Ellison, Oracle. These aren't liquid assets, they're ownership stakes in companies. And here's the part almost nobody talks about. Most of these people rarely sell, not because they don't need money, and not because they're being noble about it, but because selling, for a billionaire, is actually one of the worst financial decisions they can make. Let's say you own $10 billion in stock and you want to spend $500 million on whatever, a super yacht, a private island, funding a rocket company, it doesn't matter. The obvious move is to sell $500 million worth of shares. But there's a major problem with that, and that problem is taxes. In the United States, long-term capital gains tax sits at around 20% at the federal level. And if you add state taxes, in California for example, you're looking at over 33%. On a $500 million sale, you could hand $150 to $165 million straight to the government. Not a bill you can argue with, just gone. But there's a second problem, and this one is less obvious. Selling sends a signal. When a founder or CEO starts selling large amounts of their own company's stock, the market notices, investors see it, analysts write about it, and headlines get made. And the question everyone starts asking is, what do they know that we don't? Is the company in trouble? Is growth slowing? Is the CEO about to leave? Perception in financial markets can become reality incredibly fast, and if enough investors get nervous, the stock price drops. And if the stock price drops 20%, the billionaire who sold $500 million just watched $2 billion disappear. They sold to access their wealth and ended up poorer for it. Selling isn't just expensive. At this level, it can actually be dangerous. So what do they do instead? This is where the story gets interesting because billionaires figured out something that most people never learn in school and almost nobody talks about openly. You don't have to sell assets to use them. The strategy is called a stock-backed loan, and it works exactly like it sounds. You go to a bank, or more accurately, your financial team calls a private wealth manager, and you say, I have $5 billion in stock. I'd like to borrow $500 million against it. The bank looks at your collateral. They see $5 billion in assets backing a $500 million request. That's a 10-to-1 ratio. And from their perspective, it's extremely secure. So they say yes. And suddenly you have $500 million in cash without selling a single share. Now here's the part that sounds almost too good to be true. Loans are not income. That $500 million you just borrowed? The IRS doesn't touch it. There's no capital gains event, no tax bill, and the money arrives completely tax-free. Buy the yacht, fund the space company, acquire a social media platform, whatever you want. And your $5 billion in stock? Still there, still yours, still growing. This is why you'll sometimes see headlines about billionaires who appear to pay almost no income tax in certain years despite being worth hundreds of billions. They're not earning income in the traditional sense. They're borrowing against assets, and borrowing under current tax law is not a taxable event. Think about what this actually means. Most of us treat borrowing as a sign of financial weakness. You borrow when you need something you can't afford. But at this level, borrowing is a sign of financial strength. You borrow instead of selling because your assets are worth more to you growing than they are liquidated. And here's where the compounding advantage becomes almost absurd. If that $5 billion in stock grows to $8 billion over the next 5 years, the $500 million loan you took out barely registers. You borrowed 10% of your net worth, and your net worth grew 60%. The loan looks smaller every single year. And the interest rates these individuals pay? Because they're borrowing against such valuable, stable collateral, banks actually compete for their business, and the rates can be remarkably low, sometimes lower than a standard home mortgage. Read that again. The richer you are, the cheaper it is to borrow money. That is not a coincidence. That is a feature of the financial system, one that compounds wealth at the top in ways most people never see. This entire strategy has been given a name by tax attorneys and financial academics. They call it buy, borrow, die, and it works exactly like it sounds. Step 1. Buy assets, stocks, real estate, private equity, things that grow in value over time. Step 2. Borrow against them, live off the loans, pay minimal taxes, and let the underlying assets keep compounding. Step 3. Die. And that last step might be the most financially significant of the three. In the United States, when someone passes away and transfers assets to their heirs, those assets receive what's called a stepped-up basis, meaning the cost basis of the stock resets to its current market value at the time of death. Here's what that means in practice. If a billionaire bought stock at $1 per share and it's now worth $1,000 per share, that's a $999 gain per share. A gain they never paid taxes on because they never sold. When they die and pass those assets to their heirs, the gain can effectively disappear, and their heirs inherit the stock as if they bought it at $1,000 per share. The loans get paid off using the estate, the wealth transfers, and the tax bill, the one that was building for decades, largely vanishes. This is completely legal. It's not a loophole in some secretive sense. It's written into the tax code, but it does require a certain level of wealth and financial sophistication to access, which is part of why it stays invisible to most people. So let's come back to Elon Musk in 2021. He paid $11 billion in taxes, the largest individual tax bill in history, and his net worth still grew by roughly $100 billion that same year. That's not fraud, and that's not a scandal. That is simply what happens when the rules of money operate differently depending on where you sit in the financial system. Most people earn money, pay taxes on it, and spend what's left. The ultra-wealthy grow assets, borrow against them, and let time do the rest. Now, there's a real debate to be had about whether this is fair, whether the tax code should be structured differently, whether this level of wealth concentration is healthy for a society. Those are legitimate conversations, and reasonable people disagree. But before you can have that conversation, you need to understand the mechanics. And the mechanic is this: the richest people on Earth have largely figured out that the goal isn't to make money. It's to own things. Things that grow. Things you can borrow against. Things you can pass on. Selling is for people who need the money. The truly wealthy almost never do.